Hey guys, welcome to another Trade Genius podcast. Bob and Phil here. As always, guys, they are going to set up a great fall and you're going to be holding the bag. We're going to talk about what that means in this video. Let's dive in.
Trade Genius.
Hey everybody, it's Bob with Trade Genius. Usually I do fun ads. I talk about our service, but I want to be serious with you for a second. We've been helping a lot of people trading for a long time. As you can see here, I want to let them do the talking for me for a change. But most importantly, we want to help you too. If you've not joined our service yet, come check us out, tradelikeagenius.com. Full service. You know, we have a chat room. We have the algorithms for you. We give trades out every day. We educate you. So go to tradelikeagenius.com. Check us out. What you get out of our service is much, much more than what you put into it. And we'd like to see you in the room. Thanks for listening.
All right, Bob. So this one is just genius in terms of like how diabolical can you get? So Yellen's already kind of tapped out in terms of what she can do to prop up the economy. So what do? They let the consumers do the final leg, ultimately holding the bag once again.
Genius, more like evil genius. I mean, these people just don't care. They're absolutely shameless. And the way they're setting this thing up that we're going to talk about in a second is the government takes no risk. The banks take no risk. The consumer takes all the risk. Then they're going to lose their job and they're going to take their home. So let me throw this chart up here for you guys. So what's happening here is that HELOCs, home equity line of credits, have been like radioactive since the 2008 great financial crisis. But we've accumulated nearly $2 or $3 trillion worth of excess equity in the homes over the last, 4 or 5 years. And the government wants you to use it on the behalf of Wall Street. And basically they want you to raid your own piggy bank in order for you to live with the high inflation that they created. And then once you tap out of that, because, people aren't going to use it smartly, Phil. People are going to get $200,000 or $300,000 in their pocket. And what are they going to do? They're going to blow it on trips and toys and all kinds of stupid things. And then they're going to be left with a variable rate HELOC that, if worst case scenario happens, the 10-year yield goes to 9%. And these people are going to be absolutely buried in mortgage and second liens. And they're not going to be able to maintain the homes. They're going to then default. Banks and BlackRock are going to move back in and they just add it to their housing portfolio. And the government basically gets a liquidity pump and they don't have to worry about all that home equity going to the inherited kids, right? They're going to be, it's already going to be spent because, the government doesn't get any tax revenue or a benefit from a home that just passes from parent to child, right? Because they get a reset there. So it's absolutely amazing to me. You're talking $1 to $2 trillion potential here. And all they really care about is like, how long can we keep the Ponzi going?
Right.
And I'll throw it over to you. But when I saw this, I was absolutely disgusted. And I'm like, it makes perfect sense. These guys always look to take the easy way out.
Yeah, and it's $32 trillion, Bob, in home equity that's on homeowners' balance sheet, and there's only $350 billion that is outstanding in HELOCs. And like you said, HELOCs haven't been that popular this time around because that really was a huge issue in the great financial crisis. So I think banks have not been pushing that. But now, because they have to break out all the stops, and timing-wise, I know this is by design because of this next slide that we're going to show. But there's, they say you could see upwards up to $2 trillion that become HELOCs outstanding, and it's very possible when you have this much equity. Now, what's wild about this is because home prices are elevated right now, right? So then that's the other gotcha is that when your home price starts to fall, those HELOCs can get called, right? Because now the collateral that you once had isn't there anymore because it's declined so much in value. So if let's say markets, various real estate markets take a 30 or 40% hit, now all of a sudden, if you've maxed out your HELOC over the next quarter, spending money or doing whatever, thinking that everything's honky-dory, all of a sudden now you might be losing your home. So don't take these, especially if they're variable rates. Do not take these HELOCs right now because it's going to be tough. This is the time to be hunkering down, not taking out more debt. Now, why this is kind of diabolical is this next chart. Yeah. This is the S&P 500 seasonality map for US election years. Not only is it an election year, but they also filtered this out for when you had a greater than 5% return in Q1. In other words, when you started the year strong. What did we do this year? Well, obviously Q1 was one of our better Q1 bonds ever. So basically this is telling you that with higher accuracy that the tendency is to go up just as we get into June. So you're going to have this HELOC approval process possibly happening right as the market seasonality turns up. So they're just looking for an opportunity just to juice this thing all the way up into the election. And that's why, even though that you're going to see things like potentially unemployment start to rise, you have a lot of fuel here going into August, September, potentially to pump these markets one last time, Bobby.
Yeah, it's just amazing. And the other thing too, Phil, is that with these HELOCs, people are going to be probably encouraged to take the money out, not just get a line of credit, because they pulled them back in 2006 and 2007 too. So they're going to encourage people to spend this thing as soon as possible, and get that interest, revenue on the books. Remember, the banks have very few places now to make money.
Right.
So it's going to be really interesting to see. Yeah, and Phil, I think you're right. I mean, and if we could just change subject just a little bit too, because, we had a really good start here to May. And I think you're still looking for maybe a bit of a pullback into the end of May before we really start the lift off. Is that true?
Yeah, that's goes right into seasonality here, right? Because you're going to pull back into the end of May. And then right as you get into June, we should see a bid. And you and I were talking a couple days ago that if we're going to get this blow off scenario, then we're going to need to see June follow this seasonality and really just rip from there.
Yeah, and I think we could start even as soon as after May 15. That's when a lot of the new consensus come out for the quarter. So it's hard to be bearish here. I mean, you can be selectively bearish as you want, but, there seems to be a bid coming into the market right now, and it's going to be really interesting, guys. So just what we talked about yesterday, I think this is going to be make hay while the sun shines, but have your foot out the door so you can just bail out fast. Don't marry this move. Just trade it, rent it, and then get the cash or get into long bonds, because I think that's going to be the place to be going into 2025. With that, Phil, catch you tomorrow.
All right, guys, we'll see you in the next video. Take care.
Trade Genius.